Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review Breaking the Mould, I'm going to look at sugar, fashion and groceries. Now all three are capable of causing a fuss in the week ahead because coming up we have a full year trading statement from Associated British Foods, which pretty much straddles all three themes and they're due on Monday the 12th. We've got first half results from online and high street clothing retailer Next on Thursday the 15th. And on the same day, the 15th, we have first half figures from supermarket chain Morrison. So let's get started with Associated British Foods, or ABF for short. It runs the Primark fast fashion chain and also a range of food brands that cover everything from Kingsmill bread to Ovaltine, and it's also got sugar and agricultural operations. The shares have started to rally, perhaps encouraged by the latest UK consumer confidence and retail sales figures, which suggested that the EU referendum vote hadn't stopped shoppers in their tracks, as we can see here. At the first half stage, increased earnings from groceries, agriculture and sugar and ingredients actually helped to offset a minor fall in profits from retail and Primark. But yet another interim dividend increase from the company suggested the FTSE 100 firm remained confident in the trading outlook for the rest of the financial year. Now since that interim update in the spring, we've had July's third quarter update. That was also frankly pretty upbeat, as boss George Weston flagged a currency benefit from sterling's post-referendum plunge. So let's see what he's got to say now. For me, the key themes would be Primark, where sales were up 7% after 9 months, even if like-for-likes had come under pressure after the cold spring. Primark's operating margin was 11.9% at the Q3 stage. The pound, where Weston has flagged a weak sterling will hit Primark but help British Sugar. And finally earnings, where the boost from the pound means the firm no longer expects adjusted earnings per share to fall for the year. Note that the analyst consensus is for group sales to come in flat at 12.8 billion quid, a reported pre-tax profit of 973 million and flat earnings per share of 102p. We'll have to wait until the 8th of November to find out what the final dividend payment is though, because that's when the numbers come out. The interim was increased 3% and ABF has hiked its total payment every year for more than a decade, as this chart shows. In short, it's a well-run, soundly financed firm with a good track record. Investors just need to ask themselves whether a forward PE of around 29 times with a yield of just over 1% fits their valuation criteria or not. Now, Next. It has first half figures on Thursday the 15th, and after a rocky start to the year which featured a couple of profit warnings, shares in the high street lender have also started to rally, as we can see here. Sentiment was helped by August's first half trading update. Chief Executive Lord Wolfson revealed that total full price brand sales had risen by 0.3% in the second quarter after a 0.9% drop in the first. The boss also narrowed the range of his full year full price brand sales and group pre-tax profit forecasts. The midpoint for sales was still flat, midpoint for profits rose slightly to 810 million quid, a welcome change from the prior slew of downgrades. Also watch out for comments on share buybacks, where Next is a very vigorous policy, and also the dividend. Like ABF, Next has a terrific history of dividend increases, and at the first half stage last year, the firm paid out 53p a share. Finally, look for any comments from Lord Wolfson on the pound. He's already flagged how sterling's slide could hit profits as it increases raw material costs. Now sterling has just started to recover some of the ground it's lost of late, and if this continues then Next for one will be pleased, along with a lot of other retailers. I'm indebted to the team at Shares magazine for this chart, which shows how over 10 years the FTSE all-share general retailer sector has gone down when the pound has gone down and vice versa. Now we all know the past is no guarantee for the future, but this is one trend to note, and a similar, though less pronounced relationship can also be seen between the pound and the FTSE all-share food and drug retailer sector too. That takes us, hopefully neatly, onto the interims due from supermarket chain Morrison's on the 15th. Demoted from the FTSE 100 in December, the Bradford firm bounced back in March, although the shares have largely gone sideways since, hampered by brutal price competition in its industry. Boss David Potts is still working to stoke some profit momentum. This chart shows earnings per share at Morrison's back to 2012, and it's not pretty viewing, even if analysts do expect improvement this year and next. Potts has already extended and amended an online deal with Ocado, abandoned Morrison's convenience store rollout plan, and overseen a key disposal or two, with a view to cutting debt down to 1.5 billion quid and taking out £1 billion worth of costs. Watch out for updates on those plans and also the like-for-like sales growth figures. If they keep regressing, Potts & Co are going to be running fast just to stand still. This final graphic shows the like-for-like sales progress by half, excluding fuel, for the group, and then just for supermarkets only, excluding convenience and online. At least there's progress, but they need to get into positive territory, and fast. So thank you for watching, and I look forward to seeing you next time.